All right, everybody, it is my favorite time of year. It is TFSA contribution time. I'm a few days early on this video, but I'm going to be going over what companies I will be buying with my TFSA contribution room in 2026. I do love this time of year because it is the only tax-sheltered account I have left. I have my RSPs maxed, and ultimately anything after my TFSA has to go in my taxable account. Both of these companies are companies that I already own, but I'm taking advantage of dips in price to accumulate more shares. I do believe that both of these companies were unjustifiably beat up in 2025 or had, not necessarily poor years, but flat years. So I'm going to be adding to them on January 1st, and I'll go over my reasonings why in this video. But before I get started, I do want to mention we have a massive promotion going on at Premium. I believe it's going to run over the next few days. If you want to grab that offer, which offers massive amounts off the first year and subscriptions moving forward, if you choose to continue the next year, you can do so in the description. Stock screeners, my research reports, my portfolio, updated commentary on the portfolio. We have a private Discord. We have model portfolios. We have a Q&A. I get so many people who come to me the year we run these things and they say, oh, Dan, the market went up a ton last year. I'll just sign up later because, the markets are due for, for a retracement, or they just think they don't need a platform like Stocktrades because all they think we are is just a straight up stock picking platform. I'm giving you the opportunity to get in with a 30-day subscription back guarantee plus an unbelievable price just to kind of prove to you that this platform is a lot more than it's cracked up to be. And once a lot of people get inside, they rarely ever leave. So we only run deals a couple of times a year, the size of this one. And this is one of those times. I believe last year we had around 130 people join on this offer. So I'm going to leave that in the description below. But let's dive right into the video with the first stock I'm going to be adding with my 2026 TFSA contribution room. All right, so the first stock is Waste Connections. As you're looking at the screen here, you might notice a value score of 3 out of 10 and be like, oh, the company's too expensive. And you might have even looked into Waste Connections and noticed that the valuation ratios are quite high. I'm going to explain exactly why this is in this video and why this company is not as expensive as you would think, or it's expensive, but there is particular reasonings for it. Now, Waste Connections was actually having a relatively solid year in 2025, but then when Liberation Day came around, we can see highs of $281 per share Canadian. After Liberation Day, the whole tariff issue with Trump and things like that, and the market's kind of tendency to go very risk on from that point. I mean, there's no question we had it's probably like a 30 or 40% run from lows in the S&P 500 and say the NASDAQ after Liberation Day, and that actually might be on the low end. I'm just putting this off the top of my head. The market really does not like defensive options like Waste Connections, like Waste Management, like, a lot of other defensive holdings when the markets are as risk on as they were. So the company ended up selling off quite a bit. And if we look to year-to-date returns, we're looking at, just flat, and that would be with reinvested dividends. Now, the company barely pays a dividend. You're looking at 0.81% here, but the prime reason for that is the fact that it has been an insanely good stock to own over the last decade. I mean, when we're looking to the last decade, we're looking at 11x on your money. And this is a defensive, I don't want to say slow growing because I'm going to get into this. It's not very slow growing at all, but it's more of a defensive, business that's going to, I don't necessarily want to say thrive during any economy, but it's not going to be materially impacted by a downwards trajectory in the economy. Why? Well, because people need their trash picked up no matter what the circumstance. Now, the company does have a lot of commercial garbage waste disposal, which will be a bit more cyclical than the residential side. They have a lot of energy-based, recycling and waste, which again will be more cyclical. But for the most part, the core of this company's business is in a area that is going to be, first off, secured by long-term contracts. They're going to be inflation-linked contracts, and they're going to be something that needs to be done regardless of whether or not you're unemployed or not. So you're still putting out your trash every single Friday, whether or not you have a job or not, because it needs to be picked up. And this is a service that Waste Connections does, and it does it very well. The one thing a lot of investors might not know is that, yes, Waste Connections is a Canadian traded ticker and a Canadian headquartered company, but the vast majority of its revenue is actually in the United States. This is because of the merger of Waste Connections and Progressive Waste, which was one of the largest Canadian waste management companies. So those two merged and the company ended up, with a Canadian ticker and a US ticker. But if you look to this chart here, you can see that the vast majority of the revenue, 86% is in the US and 14% in Canada. So this is why it's very important. If you are looking to something like Canadian allocations, you are instead focusing on where the business is structured. Because if you own Waste Connections under the Canadian listed ticker and think that, it comes down to a Canadian allocation, that's just really not all that correct. I guess, yes, it trades on the TSX, but this is almost a pure play US business. So what does Waste Connections, or how does Waste Connections differ from a company like Waste Management? I would say the biggest difference is the overall acquisition strategy and the target markets. So Waste Management tends to make higher, more expensive splashes in the merger and acquisition market. It is more urban, I guess you could say, like large cities, things like that, where Waste Connections plays more of a small ball, rural type acquisition strategy. And if we look to their market selection strategy, you can tell here they're looking 60% competitive markets, primarily secondary or rural with high market share. So what it effectively looks to do is find smaller haulers in particular regions. And if they have landfills, that makes them even more attractive. And I'll get to the landfills in a second. But it buys those companies, integrates them into the fold, and ultimately drives higher margins from those businesses. It adds hundreds of millions of dollars in revenue a year through its acquisitions. And if we come here, we can see they've made 100 acquisitions over the last 5 years with annualized revenue additions of $2.2 billion. So they do believe there's $5 billion of private company revenue in the United States and Canada consistent with the market model. And really, the acquisition strategy has paid off meaningfully over the years. So the one thing I do want to show you is the pricing power of a company like Waste Connections. So if we go to total pricing growth, we can see that this company has grown prices, typically in the low single digits, mid single digits pre-pandemic. And then during 2021 and 2022, 22 and 23, they started raising prices materially. So what happened during those times? Well, if you don't remember, I'm sure everybody remembers, inflation went through the roof. And what this company was able to do, because again, a lot of their services are inflation linked, a lot of them are on long-term deals, and just the fact of the matter is people need collection. They need their waste collected no matter what. And because Waste Connections focuses on that smaller rural area, there is really nowhere else for these people to go. So they can raise prices. And if we look to 9.2% total pricing growth and 9% total pricing growth, this was over and above what inflation was. You would think 9% inflation, most companies would be very happy to just get the increase they need just to offset the added increases to operate the business. But no, Waste Connections was able to do more than that. And now we're sitting here at 3% inflation right now, but we're still seeing 6.6% pricing growth. And the one thing that this has bailed them out for a lot is volumes. If we look to solid waste growth due to volumes, we can see a perpetually declining volume since 2022. And a lot of that had to do with the fact that the economy is slowing, volumes are slowing, especially when we look to cyclical areas like construction, like energy, things like that. But when you have this core pricing growth or total pricing growth, this will offset the volume. Ultimately, it does. When you're seeing a single-digit decline in volumes, but a 6.6%, 9% increase in core pricing growth, you're growing the business regardless. Now, what ends up happening when this volume picks back up? Well, these prices, they aren't going down. So what will ultimately end up happening is they will benefit from this core pricing growth as volume recovers, which we should see maybe over the next few years here. Now, just some quick highlights from the slide deck. We can see revenue here, 11.3% compound annual growth rate, adjusted EBITDA, nearly 13%. We're looking at margins, they're 33%. And that has increased by, 2.5% pretty much since 2022. We're looking at free cash flow, 11.3% compound annual growth rate over the last while here, and we're looking at it continuing in 2025. And really, that's all I want to talk about the company for. Now I want to kind of get to the valuation, because when we come to the valuation here, we're looking at very expensive multiples for Waste Connections. We're looking at 72x price to earnings. We're looking at 36x price to free cash flow. And we might be sitting here thinking, why would I ever pay 72 times earnings for this company? It's growing at a 10% pace. Why don't I just buy Google and, pay what would be 40x earnings and grow at twice that pace? The one thing here that is very important to understand, this is a company with a lot of tangible assets. When we think of a company like Google, a lot of it is intangible. You can't actually physically hold the assets. Whereas a company like Waste Connections, landfills, trucks, all that type of stuff, they're tangible physical assets. And the one interesting thing here, and the one reason these companies trade at very, very high multiples, is on the balance sheet, these companies' landfills that they have acquired over the years, they are on the balance sheet at historical cost, what they paid for them. So this is a US accounting situation. With GAAP, generally accepted accounting principles, something you acquire 20 years ago, it's still on the balance sheet at the historical cost. Whereas IFRS, which is what we use in Canada, you are allowed to kind of rate those assets up, increase the value of those assets on the balance sheet. And the one thing people might get confused with is, yes, Waste Connections is a Canadian ticker, but it reports GAAP earnings because, the vast majority of the business is in the United States. So you have these landfills that are on the balance sheet at historical cost that have actual value substantially higher than what they are on the balance sheet. So this is why you often see these companies. I mean, we're looking at 5.5x book. Obviously, it's almost impossible to get these landfills, created, new landfills. I mean, there's a lot of not in my backyard type situation with something like this. There's a lot of, they take up a lot of space. They're not very, nice to look at. Just quickly, if we come to the landfill revenue here, we're looking at an 8.37% compound annual growth rate over the last 10 years. And this growth rate, it is highly unlikely to ever slow down materially. Now we're seeing a slowdown the last year here, probably because of the decline in volumes. But ultimately, the landfills are huge moneymakers for this company, especially when we think of how fragmented the industry is. Because if a smaller hauler uses a Waste Connections landfill, it's got to pay a tipping fee. So those tipping fees are very high margin, and Waste Connections, ultimately that's how they can leverage acquisitions of these smaller haulers. So yeah, I like the company. It took a bit of a year off, but I'm not really all that concerned about a year off in a situation where the markets were very, very risk on. This company still has plenty of runway, in my opinion. I think it's around half the size of Waste Management, and it only owns around 7% of the market, despite being the third largest waste disposal company in North America. So lots of potential upside for this one over the long term, in my opinion, and that's why I'm adding more. Now, the second company I am going to speak about, I have beaten to death over the last while here, but I'm going to talk about it again, and that is Constellation Software. Now, Constellation Software had the ugliest year in its history. Effectively, you're looking at minus 25%. And if you had bought this company back at the peaks here in May of 2025, you're actually down like over 40%. And I had mentioned in a previous video where I spoke on my biggest losers on the year, this is where a lot of people started getting interested in Constellation Software. Unfortunately, I mean, if we look at 10-year chart, it's pretty much up and to the right. And right around the peaks here in 2025 is when a lot of retail investors started saying, oh, maybe I should buy this company. It's done very good in the past. So now we're sitting on a large drawdown, and a lot of people are frustrated with this company, despite the fact that this company is still doing outstanding operationally. And one of the main fears here, obviously, is that, the fear that AI is going to take over this company's business. People are going to be able to vibe code a lot of their software. They're going to effectively fire Constellation or get rid of Constellation in order to save a bit of subscription costs for their software. They're going to do it themselves. And I just think that's a bunch of nonsense at this point in time. It gives me very similar vibes to Alphabet back in the day when ChatGPT first came out and Alphabet was going to get wiped out by this. Google search was, going to be wiped out because why wouldn't anybody just go use ChatGPT? Why would they ever use Google search? Blah, 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 all that type of stuff. Google went through a huge drawdown. I ended up buying a ton of shares there too. And the company's just ripped as of late because not only is it not getting ran over by AI, it is probably one of the best positioned companies in the AI space. And I think Constellation will be able to take artificial intelligence and turn it into a tailwind what it's going to be able to do with AI, it's going to be able to implement code much faster, because there is no doubt that ChatGPT can construct code at a much faster pace than humans. It will absolutely destroy humans 10 times the rate, I would say, and we're still in early stages. However, AI cannot debug this code yet. So Constellation is going to take AI, it's going to be able to utilize AI to create code faster, and what it is ultimately going to be able to do is create AI functionality for a lot of pieces of its software that it's going to be able to use to enhance the user experience, increase its average revenue per user on, a lot of the software it owns, and it's going to turn this into a profit-generating machine. Now, I do believe 2026 will be a strong year for the anti-AI crowd, not just Constellation Software. We've seen companies like Adobe, Salesforce. In Canada, we have companies like Descartes, Thomson Reuters that have had big hits in price because they believe AI will overtake the business. I just don't think this is true. And with a company like Constellation, it deals with a lot of mission critical VMS pieces of software, meaning if that software does not operate, your business does not operate. You will not generate revenue, or at least it will become a lot more complex. There'll be a lot more headaches. Things don't function as well as they should. So I think it's a little bit early to think that we'll have companies that are just throwing Constellation in the trash. They're canceling the piece of software because they have a internal coding team that can, vibe code 10 million lines of code and create this piece of software and then debug it when ultimately things go wrong. If you start to think of it from that perspective, it begins to seem a bit silly. So for this reason, I am adding, there's also the other added risk that obviously Mark Leonard is resigning due to health issues, but Mark Miller has been with this company for 30 years. There's a lot of continuity here. Mark Leonard is staying on the board, and with Mark Leonard on the board and Mark Miller at the helm, I really don't think there's going to be much of a stumbling block in terms of acquisition strategy here. If we look to free cash flow available to shareholders, it has never been higher. Over the last 12 months here, we're at $1.74 billion. We come down here, it is compounded free cash flow available to shareholders at a 18% pace. So even if there is struggles in this business, let's say it cannot acquire companies and turn out this compound annual growth rate, it doesn't need to. Effectively, this could slow down to, let's say, 12 to 15%, and we could still have a market outperformer, because it is very difficult for companies to compound free cash flow at that pace over the long term. Now, will the company trade, if this happens, will it trade at the multiples it used to, the 45x free cash flow? No, but right now, we're getting to the point where it's nearly sub 20x. We're looking at 20.3x, whereas, 5-year median averages 31 effectively, 10-year median averages 27. So we're looking at large scale discounts to the company's historical pace. And if we look to the PEG ratio of 0.22, the market is effectively pricing in very, very little of Constellation's growth moving forward. And the reason they're doing this is because a lot of the market believes it will be disrupted, but I do not believe it will be disrupted. Now, the one thing about this is, in relation to, let's just say, a Waste Connections, where the business is solid, the moat is solid, everything's intact, and there's really nothing that could disrupt a business like Waste Connections. The fact that AI exists and could disrupt Constellation still does exist. Now, do I think it will? No, but do I think that it's a 0% chance? Absolutely not. The market, it can be inefficient at times, in my opinion, but it's never just outright wrong when it sends a company south like this. It is pricing in a lot of forward risk that does exist, but I just don't really think that it is as guaranteed as the market is pricing in right now. We're talking about going from $5,200 all the way to $3,300 in a matter of, a few months. It has been a drastic drawdown for pretty much all of Constellation's companies. We're talking about Topicus, we're talking about Lumen, we're talking about Constellation Software, and I just think, I'm not going to beat this company to death in this video because I've done numerous videos on Constellation, so you can go back and see those if you want a bit more in depth, but I am going to be adding this one in my TFSA. Now, whether I choose to add some of this and more of Topicus, kind of in the air right now. I might end up doing that, but I didn't want this video to drag on too long, so I'll more so say I'm going to be looking to add Constellation and potentially the SpinCos. I have been adding a lot of Topicus recently, so I'm going to have to see where I sit in the new year. But that's pretty much it for the video, everybody. Waste Connections, one of the best companies in the country, I think, in my opinion. Founder-led company since the mid-90s. He had to leave in 2019 for health reasons, but he's back at the helm. I am a big fan of founder-led companies, and although Constellation Software is not a founder-led company anymore, I do believe the transition from Mark Leonard to Mark Miller will be relatively seamless. And although I do think that this company needs some risk priced into it, because of the potential disruption for AI, I think it's overblown, and I think there's actually a reasonably good chance to have Constellation turn AI into a tailwind. So if you like the video, everybody, head down below, like it, smash the subscribe button, hit the notification bell, drop a comment, let me know what you're going to be buying with your 2026 TFSA room. Happy New Year, everybody. Hope you had a great holiday. And again, there is that link down in the description for the premium platform discount. There's not only a lifetime discount on future years, but there is a big discount on your first year to help you get into the platform and see what it's all about. Hop on the Discord, say hi. I'm interacting with, I believe there's over 1,200 people in our Discord right now, and thousands of premium members overall. You can hop in there, shoot me a message. I'll be sure to reply, and stay tuned for more great investing content.